Hello and welcome to this interview series where we bring you face to face with the people who manage your money. Like every week, we'll delve into the strategies, philosophies, and changing dynamics of the financial markets through the eyes of a seasoned professional. Today, joining me and my colleague Chirag is Rupesh Patel, Senior Fund Manager, Equity Investments at Nippon India Mutual Fund. Welcome, Rupesh.
Thank you. Thank you, Ruchira.
Now, to start with, can you please tell us what drew you to the equity markets, considering your background in civil engineering and your work as a project manager at Gujarat State Road Development Corporation?
Okay, I mean, on a lighter note, maybe being a Guju, it was always in my genes. But on a serious note, I think if we look at equity investing in its truest sense, then it's about finding a right business. It's about partnering, finding a right business and partnering it, and then stay invested, stay put. So if your bet plays out, then the rewards are disproportionate. So, I mean, you keep trying, you keep looking at businesses, and similarly, if you go wrong, I mean, the payoffs can be very bad. So, I think this challenge of looking for businesses, looking for right partners, and investing them in them, and staying put as they scale up, and in the process, you see the payoffs. I mean, being huge. I think this whole challenge is what has attracted me to equity markets, and yeah, I think that is the biggest draw for me actually.
But Rupesh, what was the basic thing, or what was the when did the idea come to go into the equity markets? Because you have done your civil engineering, so what triggered to go to do the
That
MBA?
particular move, what was the point that
Yeah.
triggered, that move from one profession to another?
So, true. So, when I was doing my engineering at that time, I was actually a hardcore technocrat, like, was really keen on subjects like structural engineering, foundation engineering, advanced construction techniques. They used to be my favorite subjects, and I used to do really well in some of them. But after my engineering, I thought maybe, it's still time to learn something new. And instead of going in specialization for in engineering itself, I thought of widening my horizon, and that's why I thought of doing my MBA. And once I got in, I mean, the subjects and all, I kind of developed a liking for numbers, and the way businesses are constructed, the way businesses scale up, the way wealth gets created in stock market. And that is when I actually started liking the whole thing. Though my first initially, I mean, when I started my career, that was into project development, hardcore development of project, identifying projects, carrying out pre-feasibility studies, establishing their viability, and managing the bid process and all. That was exciting, but somewhere I felt, that my heart lies somewhere else. So when I joined CARE, Credit Analysis and Research Limited, that's when that passion kind of really, helped me. And in the initial period, like going through the balance sheet, studying annual reports, and all that kind of laid right foundation, because that passion was always there. But experience of working with a credit rating agency really taught me the fundamentals. I mean, it gave me real tools to really analyze businesses and look at them from right perspective.
So you've had quite a journey from working at CARE, as you mentioned, to PMS and, spending around 13 years at Tata Mutual Fund. So can you share with us what are some of the key lessons you've learned from your experiences at these different organizations?
Yeah, sure. You're right. I mean, almost 24 years experience spread across project development, credit research and rating, real estate investing, equity research, and public equity management. So it has been a credible journey, and in a way, I consider myself lucky that I got exposure to these, I mean, multiple things across the spectrum, and that in a way helped me, I mean, shape myself as an investment professional. Talking about learnings, I think again, in my career, both at CARE as well as Tata Mutual Fund and here at Nippon also, I have worked and am working with a lot of people who are very knowledgeable. They are smarter than me, and in that sense, the learnings from them, I mean, has influenced my thinking to a large extent. If I talk about specific things, then working with a rating agency really taught me importance of balance sheet, importance of cash flows. Talking about my career at Tata Mutual Fund and in equity investing, the skills like looking at the longer term opportunity, looking through the noise, virtues of being patient. I think these are some of the skills which I have acquired from my colleagues, my seniors, and I mean, these different organizations I have worked with.
You have worked with Tata Mutual Fund for about 13 years, kind of thing, rising from doing the equity research, then PMS, and then doing the fund management. So how has these the varied roles, shaped up your investment style or the management while working at the Tata Mutual Fund?
Sure. I think the journey from being a research analyst to a money manager, initially in PMS and then on MF platform, it has been a journey of evolution. So, I mean, obviously, when you are research analyst, you are focusing at, few sectors. But as you become money manager, you have to widen your horizon. You have to develop expertise across multiple sectors, across multiple companies. So in that sense, it's evolution, but very specifically as an analyst, the companies, the sectors where you are tracking, you really, go deep into them. A company you would want to go, I mean, line by line, try to understand why a number is there, what is driving that and all. But as a fund manager, you may not always have that luxury. So as a fund manager, you have to figure out that, what are those key factors which will drive value creation in that business and how markets would really, or market factors will impact those factors. So in that sense, I mean, moving from being a specialist to a more generalist, I think that's the journey which one goes through, and I have also gone through and still learning from the markets.
Given your 5 years of experience at Care Rating, how is your background in credit rating influence the way you assess and manage risk in equity investments?
Yeah, I think it has played a big role. So if I go back, I joined CARE in November 2001. That was the time when we were coming out of previous cycle. That is when I actually learned that how in previous cycle companies, what mistakes they had made and how, they are coming out of that bad cycle. I saw balance sheets getting repaired, businesses being rebuilt. And then I was there till August 2007. So I saw that complete cycle, that when money is easily available, how promoters become ambitious. And this whole idea that money will always be available and there will not be any refinancing risks leads to promoters taking undue risks, leveraging their balance sheet significantly. We saw, I mean, many instances where promoters themselves got leveraged. And when the cycle turns, when availability of money on tap is not there, you see all these things come back to haunt you. So in that sense, my experience at rating agency really helped me seeing, I mean, how risk gets built up in a cycle. And so, I mean, today when I look at my investing career, the learnings of those 5.5 years have stayed with me. So things like, you want to see that how profits are getting converted into cash flows. You want to see that balance sheets are not significantly leveraged. You want to see that balance sheet strength is one of the key for long-term growth and survival of a business. So I think these are some of the things which have stayed with me in my investing career and has really helped me navigating my portfolios during, I mean, times where macroeconomic conditions were not great. And like 13, 14, 15 is when we could really avoid a lot of highly leveraged companies and avoided actually making big mistakes because of this grounding in credit risk.
All right, Rupesh, now moving on, can you tell us about your overall investment philosophy? Like what types of stocks or market conditions really excite you?
So my basic belief is that in equities, you make money by buying good businesses. Basically, you look for businesses which can grow at reasonably good rate over a longer period of time. So when you find such businesses, such kind of growth can happen on account of their linkages to economy. It can happen on account of trends on premiumization playing out, these companies gaining market share. So the reasons can be many, but where you can see visibility of growth, if these are run by decent management teams, and balance sheets are not highly leveraged, that is when you make most of money. So the idea is when you find such businesses and you buy them at right price, the trick is you remain invested and stay long in such businesses, and that should be core of your portfolio. Secondly, I have also seen that in my experience, a lot of great investment opportunities come when there is gap between market's perception of risk and the actual risk. So look for such I would say, misplaced risk reward equations in the market. It can happen on account of company specific factors, industry specific factors, or it can be just market specific factors. So look for such opportunities tactically. And third, look for businesses where there can be some kind of optionality around them. So these are businesses where if those optionalities play out, the payoffs can be very rewarding. But the large part in first bucket where you believe that you invest in good businesses and stay invested as they scale up, you as an investor benefit from that scaling up.
So, Rupesh, in terms of stock selection, what are the factors which convince you to make a compelling buy, to go and buy that particular stocks?
So, as they say, there is no holy grail in investing. So, there is not one single thing which will attract you to a stock or which will make it a must buy. But still, if I have to give you, couple of things which I look at, and they generally play a role in me deciding to buy a particular stock is a market cap relative to size of opportunity. I think that's a very big starting point, particularly for businesses where you want to take a slightly longer term view. Second is obviously management quality. Third is how capital efficient the business is. A business which can generate high return on capital and high return on equity over longer periods of time generally tend to reward investors in a superior way, provided you have paid right price for it. And finally, a strength of balance sheet, because in bad times, it's the strength of balance sheet which will help you see through. So I think these are some of the factors which I keep in mind. What I clearly try to avoid is particularly at the time of narratives, whether on the positive side or negative side. I think instead of getting carried away by market narratives, looking at numbers really helps you taking decisions which are more objective and more rational, and you are not carried by your emotions actually.
Rupesh, you mentioned that you steer clear of narratives, market narratives, but now could you share some early warning signs or red flags you look for in equity investments, especially those you learned to identify during your time at CARE?
Yeah, sure. I think that's a very good question. And as I said, my stint at CARE really helped me in kind of shaping up my investment philosophy. So there are many, but again, if I have to list a few, I would say look at capital allocation decisions. Bad capital allocation decision just to, for growing your P&L or growing your balance sheet. I think that is first red flag which I would look at. So any business, however great it may be, if you see unrelated diversification, bad capital allocation decisions, that's definitely a red flag. Secondly, I would look at related party transactions. Significant unrelated related party transactions, that's another red flag which I would watch out for. And finally, I think accumulating significant leverage on the balance sheet. That's another thing which I don't like. So, I mean, I can put it this way that a company which chases growth at the expense of balance sheet is definitely a red flag for me to consider.
Now, coming to the specific fund, specific questions, you manage Nippon India Growth, which has completed around 29 years of existence. How has the fund adopted its investment strategies to navigate different market cycles and economic conditions over the years?
So I'm managing this fund since January 1st, 2023. If we look at current situation, then I mean, our approach is that we look at opportunities in terms of three buckets, and it's pretty similar to the philosophy which I just explained. So bucket number one, where we tend to allocate large part of our portfolio, is basically look for businesses which can become much bigger in size as compared to what they are. So the trick over there is you buy them and you remain invested. You don't think in terms of next few quarters. You don't worry about any market related near-term noises like, maybe what would Fed chairman say in next speech, or what would RBI do in its next credit policy. You really think more in terms of years. So that's the core of portfolio. That's where large part of portfolio gets allocated. Second bucket, I call it bucket of mispricing, wherein because of company specific, market specific, or industry specific factors, there can be mispricing. Market may have overreacted to a near-term news, and or because of some narratives, stock price is giving you a superb opportunity to get in, and the risk reward equation is very, very favorable. They may not be very great businesses. They may not be businesses where you would like to, or you can think of remaining invested for many years to come. But just from the price perspective, they are very attractive. So that's the second bucket of opportunity which I look at. And third, as I said, businesses which have some kind of optionality around them. So maybe some of the new age tech businesses will fall in that category, wherein we know the opportunity is huge for them, but not all of them will succeed. But those who will succeed can capture the profit pool significantly, can create and capture that profit pool substantially over there. And hence the payoff for a patient investor can be phenomenal. So some allocation to such kind of businesses with optionalities. Not that all of them succeed, but a few of them who will succeed. I mean, the payoffs make up for those which do not succeed. So I think combination of these three approaches is what we are following whilst constructing the portfolio of this fund. And that seems to be working as of now. Our approach remains the same. So it's not that markets are inserting, phase. So that's why we are adopting it. I think my investment philosophy, which I articulated in one of the earlier questions, it's pretty much similar to what we are doing in this fund.
Since you manage midcap fund, the midcap index is up by around 25% year to date. So where are you finding the opportunities in this dynamic market?
So you're absolutely right. If you look at midcap as a category, last few years have been phenomenal. Returns are phenomenal. And if you look at most of the businesses, then they seem to be very perfectly priced, leaving very little room for disappointments. But there are pockets of opportunities. So, for example, we have exposure to some of the consumer companies where, they have not done anything in terms of their price performance over the last 2-3 years. One, their starting valuations were on the higher side, and at the same time, they have faced headwinds in their own businesses. So I think as a result, there is a good time correction which has happened there, and valuations have also corrected from the highs where they were. So I think we are getting closer to a point where we will see uptake in some of the consumer demand and have selectively started looking at names in that space. Consumer discretionary is what attracts us. Plus, it also fits with the long-term opportunity which India offers in terms of growing per capita income and thereby your growth driven by premiumization and improving penetration levels. Second segment, which we like, is on the financialization of savings. Again, I believe that this is a longer term trend, and as awareness levels go up, as per capita incomes go up, and we meet our basic requirements, there will be surplus amount of capital which will be invested. So beneficiaries of this financialization of savings, which would include exchanges, which would include distributors of financial products, apart from lenders, I think are some of the examples where, or say some broking firms, or say asset management companies. I think this is the second category which we like. Third, I think power sector, we believe that provides good opportunity in the sense that last 10 years or so, we have not seen significant investments happening in the sector, whereas demand has continued to grow. So the supply demand is very finely balanced, and at the same time, newer opportunities getting created on account of India's commitment to to take its renewable energy capacity to 500 gigawatt by 2030. So I think combination of these three, we believe that would benefit the entire ecosystem around power. And that's where we have some meaningful exposures. So yeah, I think these are some of the sectors where we have exposure in our fund.
All right, now since we're talking about the midcap fund, your Nippon India Growth Fund, you have nearly 100 stocks in the portfolio. So can you please explain what does such a high number of holdings indicate about your investment strategy?
Yeah, sure. I think if we look at number of stocks, I mean, today as we speak, we would have about 92 stocks in the portfolio. One, I think a lot of stocks which you are seeing in the portfolio in the tail, they would be either in the tail because, I mean, we are still in the process of building up our positions, or they would be in the tail because we are in the process of exiting out of them. That's number one. It's a large fund, so it takes time and to build positions or to exit from a position. So that's number one. Number two, it can be that we are trying to play a theme and there are multiple stocks to play that theme. And instead of betting on one single stock, we have made a basket of stocks considering the liquidity available and reduce risk. Instead of one stock, we may have made a basket of 3, 4 stocks. So that is second reason because of which number of stocks appear to be on the higher side. Having said that, if you look at top 10, top 20, or top 30 stocks in the portfolio, the concentration remains pretty high, and it's a tail because of which number of stocks appear on the higher side.
Rupesh, you spoke about, at the start in your invest strategy that you like investing in the good quality companies. And at the same time, we have also seen that the equity markets have risen in the last 2 or 3 years, 3 to 4 years kind of thing. So does the high valuation concern you because we saw some of the high P stocks in your portfolio?
Yeah, no doubt. I think valuation is, I would say, one of the most important thing. So your entry valuation actually is the one of the most important thing which determines your future returns, and hence you have to be cognizant of returns at the time, valuations at the time of entry. No doubt. I mean, some of the stocks which you are seeing today in the portfolio have, on reported basis, very high P ratios. But I believe that that some of it is because we are looking at earnings on depressed basis. Like I gave you example of some of the consumer discretionary names where earnings are depressed and we are looking at multiples. Secondly, I think P I mean, maybe it's a very shortcut way of looking at valuations. But I think some of the businesses which are there are very quality businesses, have ability to generate decent ROE, ROCs over long periods of time, are good cash throwing businesses, and valuations, though on PE basis, appear on the higher side. But I think it's their ability to compound over long periods of time should generate returns for investors. So our approach is that instead of getting bogged down in a particular investment style, I mean, try to keep yourself very diversified. So that's another way of actually managing risks in the portfolio.
All right, now to wrap up this chat, one last question. What has been the most surprising market trend or event that you've encountered in your career, and how did it influence your investment approach?
Oh, I think it has to be definitely COVID, because the challenge at that time was that for a reasonable period of time, it was very difficult to figure out that what impact is temporary and near term, and what is going to be the longer term impact of this particular event. So that posed some challenges, and I would say it was one of the most challenging period, not only for me, but would be for most of investment professionals. But the learning, I mean, again, the learnings of working with a credit rating agency really helped there. That at the end of the day, resilience comes from strength of balance sheet. So if you had good balance sheet, if you had, manageable debt on your portfolio, you were able to see through those tough times. And finally, the biggest learning, which all of us should remember in investing, is that investing is probabilistic. At the end of the day, equity investing is all about dealing with probabilities.
All right, well, it's time now for us to wrap up this chat. Thank you, Rupesh, for taking the time for this interaction. It was great having you.
Thank you, Ruchira, and thank you, Chirag, for having me on your show.
Thank you.
Thank you.